Welcome to PrimeAlpha's interview series, insights from industry practitioners discussing their journey and their discoveries. Hello, my name is Amanda Jogia, the CEO of PrimeAlpha, an online ecosystem bringing together alternative opportunities and their investors. I would like to introduce Dayan, founder and CIO at DWD Partners, a global macro hedge fund manager with a strategy that monetizes discretionary macro and volatility views through the trading of cross-asset spot, forwards, futures, vanilla, and exotic options. Welcome, Danny. Thanks for joining us.
Thank you. Thanks for having me, Amanda.
Let's start by talking about what led you here. Tell us about your career journey.
Sure. I have a very unique background, actually, in the finance industry in arriving at this juncture. I started out initially, right after undergrad, in a risk management consulting position, where I was advising clients, large institutional investors, on best practices in hedging exotic option portfolios. Great experience, really got a chance to learn the products, but I was always one stage away from the markets themselves. So this led me to say I wanted to pursue an advanced degree. I did the CFA program and as well went to University of Chicago to do my MBA. I happened to be there during the crisis and focused on economics as well as quantitative finance. But being there during the crisis was extremely beneficial for my growth. We were talking about what was happening exactly at that time. We were talking about central banking and all the responses that policymakers were doing to the crisis. I knew after graduation that I wanted to be in a more macroeconomic type of role. And so I ended up joining Credit Suisse on the interest rate sales desk, advising clients, mostly macro hedge funds, on option positions, derivative positions to express their views in the interest rate markets. Great experience. Ended up learning a lot from my clients as well as from people in the firm. Ended up going to another broker-dealer to build an FX and rates business. Spent about a year there. And then after those roles, at one point I had a client come to me and say, look, been designing trades for me for years. You have great ideas. I don't want you to do this for anyone else. Come work for me at my fund that I'm launching. And so I joined a hedge fund in 2014 and ended up being a co-portfolio manager, managing about 150 million with the founder of the firm. Great experience to be able to broaden out into other asset classes. Ultimately, the firm had challenges in fundraising like many hedge funds do. And so when I ended up deciding on my next move, I spoke a lot with a number of different investors. And I continuously heard feedback from them that they were frustrated or disappointed with their hedge fund allocations. And so this led me to design and think of and then design a new concept for a hedge fund, one that we think can be quite transformative for investors.
Describe for me that pivotal point in time where you decided to go off on your own and solve for this pain point.
Well, it's interesting. It was never part of the plan. I think everyone has a career plan. I never really thought that that was what I wanted to do. It wasn't like I was gearing up my career for that and taking steps to get there. It was really that I saw an opportunity in the markets that wasn't being addressed. There are good hedge funds. There are hedge funds that have struggled. But what we really found was the key feedback we were getting from investors was that they do not believe interests are aligned. And we think that's very important because as a hedge fund manager, you're operating at the behest of clients, right? You're working for their benefit. And if they don't feel like the interests are aligned and that we collect fees in all cases, even when they're perhaps undeserved, performance is unsatisfactory, we found that there is actually a way to address these needs in a quite unique fashion.
How do you align that interest?
So the first thing we decided was that the management fee was consuming a significant amount of the performance that fund managers generate. And so fund managers generate P&L, that's a gross P&L, and then ultimately charge fees to the client. That becomes the net P&L for the investor. And we found that the management fee, which is charged irrespective of what the performance is, eat up a significant amount of that performance. And it also just grows quite large as the firm assets grow to the point where it becomes a profit center. It's not just for covering costs. And what we actually determined through analysis of this is that number one, doesn't align investors and the manager in the pursuit of performance. And secondly, it incentivizes the manager to grow as large as possible, more so than to focus on satisfying their clients. And so we decided no management fee for our initial fund, and we just charge performance. We also determined that there were other needs not being met, and that there are a lot of different types of investors in the industry that allocate to hedge funds. There's pension funds, there have a very specific goal in mind, insurance companies, there's fund of funds, there's wealth managers, and then there's the family office community, which is typically managing the wealth of the family themselves. It's their wealth and they're managing it directly, or they have someone managing it for them. And all of these different investors have different needs. Now, in a typical hedge fund, you take any of your investors and kind of just throw them into one giant pie, right? One pool of capital, and manage it in one size fits all. We actually determined that you should split out these investor types into different tranches or risk buckets and allow them to achieve their objectives in a more direct fashion.
That's really, really interesting. The two things that you talked about, alignment of interest and really embracing that not one size fits all, obviously is a given. But how else do you help your clients?
Sure. I think our strategy is quite differentiated as well. So obviously, we just talked about the fund, but it's important to talk about the strategy as well. Our research process focuses not only on short-term mispriced markets, but also longer-term factors that we think are often neglected by people in the industry. Things like demographics. And demographics were very influential for me in my career in identifying turning points in interest rates in 2014. And we think that they're also presenting a turning point for interest rates now that is not being paid attention to by markets at all. Now, they don't affect the markets in the short term, but we think that they're very high conviction views for the long term. And investors should be looking at both short term as well as long term. The second thing is that the products we trade, they're quite uncorrelated to the market. We trade both simple derivatives, we trade more exotic derivatives as well. But our risk management process is such that when we're wrong, we tend to keep our losses quite small. And when we're right, in identifying mispriced markets, we can capitalize that with larger returns.
You talked about investors coming to you talking about their hedge fund portfolios. How should they think about hedge funds, what you guys do within their portfolio?
Well, the majority of investors are invested in the equity market in one way, shape, or form. And whether it's directly through their buying and selling of stocks in their portfolios or through allocations to hedge funds, the majority of hedge funds out there are equity oriented, especially given the run in stocks in the last few years, I should say 10 years at this point. We think it's important that investors have a manager in their portfolio, or allocators have a manager in their portfolio that is actively looking to hedge against risks. And so, for example, we identified a number of different times where the equity market was susceptible to a pullback and try to capitalize that through option trading strategies. We think that's very important for investors who are far too often hurt by equity volatility and equity drawdown.
Interesting. I love hearing your story because it really talks about the opportunity set and the product, but really thinking about your mission and vision and how you help your clients. What do you feel that you did right? We always talk about what did you do wrong and what did you learn, but what did you do right? Because I feel like you did so many things in a very conscious way.
I think I approached things from a very gradual perspective, understanding that I didn't know everything as I was starting my own firm. I sought guidance from a lot of different people. One of our investors sits on our advisory board. I routinely ask advice and insights, and I think ultimately that leads to better business decisions, having just started my first business. Secondly, I think my first couple hires are the right members for the long haul. And I think that's key because I can't do everything myself. I have to have support from my team. And I think I've really gotten good couple hires in the initial stage for the firm, and hopefully more to come.
So since starting your firm, how have you developed or pivoted your thesis or business, and why?
I think what's been the biggest challenge is just how erratic the markets have been. As a macro fund dealing with 2021 in the post-COVID world, the markets have been quite erratic, in some cases even dysfunctional. That's forced us to be, I think, a little bit more short-term focused than we would like. We think as the recovery progresses, we'll be able to focus a lot more on longer-term, high-conviction ideas. Right now, as a first-year firm where you're very conscious of mark-to-market volatility on the markets as well as in your portfolio, that's a bit of a challenge. So I think that we've acknowledged that the world is still quite uncertain and that the markets are moving in unprecedented ways or reacting in unprecedented ways to the environment we're in. And so we've had to pivot and be a little bit more short-term than we would like. But we don't want to be in that way for long. We want to be able to focus as well on our longer-term ideas.
So what gets you excited every day, whether it's the markets or your business? Like, what gets you excited?
Well, first of all, I love what I do. I'm very passionate about it. I get every single day to come in and express my views in the markets. I get to put on trades. The way our strategy is set up, we can trade any asset class and we can trade almost any type of product. And so we really have a blank canvas when we have a high conviction view. I would say what gets me the most excited is when I have a contrarian view to the market mindset. Put that on, and then when it works out, obviously, we're happy. But to have it, that contrarian view and see that play out is far more enjoyable for me than having a consensus view and generating P&L in that.
The intellectual. So here's my favorite question. What do you think is your superpower and why?
I think it's my analytic nature, in that no matter what the circumstances are in the markets or in the economy, can be quite stressful. I tend to focus on the analysis itself, on the data, that all the work that we do. And I think being able to keep the emotions out of things and focus on the work itself and the data itself leads to better decision making. So I think it's better from a risk management perspective, obviously. I also think it's better from a trading perspective. And hopefully my colleagues also think so as well.
It's really interesting because your background, you went to University of Chicago, super analytical, right? Super quant, all the places you worked for, all the people you worked with. Who would you say has been the most influential in your career and why?
I'd love to give him a shout out. And Harley Bassman was someone that I had the pleasure of working with at Credit Suisse. He was a senior advisor, essentially looking at a lot of different longer term trades and ideas. And that really opened my eyes because most of the clients I was dealing with were looking at shorter term ideas. And I realized that the longer term ideas, they're harder to come by, but they offer far better risk versus reward trade-off. And so when you do find these longer term ideas, they're very, very attractive and very appealing to have in a portfolio. And so he was someone that he looked at longer data. He was trading 10-year options. He was trading 20-year options. And these are things that I'd never even thought of looking at. And it really opened my eyes to look at them across all the different asset classes.
It's so interesting. I feel like who you are today is the culmination of 100 different pieces and all these people we've met. So it's super fascinating. Danny, thank you so much. I appreciate your time and your story, and I hope to have you back on again.
Thank you so much, Amanda. It was great to speak with you, as always. Thank you for having us on.
Thank you for listening to PrimeAlpha's Visionaries and Innovators podcast. As always, you can head over to primealpha.com to sign up to our email list, as well as check out our other podcasts. See you next time.